Hello, everyone, and welcome to the weekly roundup. Today, we'll cover China's economic updates, recession concerns, and recent trends in the energy sector. Hello, Ben.
Hi, Eva.
Good
Beautiful,
week.
beautiful day today.
Yeah, yeah. It was cold this morning, though, but it looks better now.
Definitely.
I feel like this season is colder than normal.
Maybe that's hopeful. Cold's only coming.
Oh, no. Okay, let's get to it.
Sounds
Kicking
good.
things off with China. Last week, we had noted that they were making some fiscal announcements over the weekend. Anything worth noting, and what was market reaction?
So that's a good question, good point. I think there's a lot of anticipation with what would come out fiscally. And as I noted, they try to release it on the weekend when there's not much market action, of course, as a result of it. So it was probably in the middle of what people were thinking. I think there was some hope because their monetary was so stimulative that they thought fiscal would jump on as well right away. So I think it was a little bit more muted than anticipated. So we started the week off with China down off of that news. Then we had some GDP numbers from them last night, I guess this morning, and it was a little bit better than expected. And so there's a slide that I'll cover that shows a little bit more details on GDP and inflation, deflation over there, which I can comment on. But I'd say generally it was lighter than expected. My view still is that there's tons of upside and potential with China. As you know, we'd sold it, but certainly a lot of volatility still associated with it, and maybe it's a position we look to add back to as the economy probably is bottoming here and lots of noise going on. But they really need to step on fiscal stimulus if they want their economy to recover quickly.
Okay. A couple of risk monitors seem to point to a possible recession in the US. What are the numbers saying, and what is the implication of this on future rate decisions?
Yeah, so I think when we came into COVID, I didn't really anticipate how screwed up the numbers were going to be forever. And so I think what's transpired since then is we've had a lot of choppy numbers, a lot of things that used to matter don't seem to matter as much from a market and economic perspective. Like a lot of people used to pay attention to the University of Michigan sentiment indicator that was, that rated how the consumer was feeling, how businesses were feeling. And for the last 2 years, those numbers have really been irrelevant to what's happened in the markets, but historically it was a positive. So, I think we had that back and forth. Certainly in the US, we've had the jobs numbers a little bit better last week, inflation a little bit worse. So that's affecting what's going to happen with rates at this point. So I think that's still the case. I still think we're looking at a rate cut in November in the US. I think when we came into last week, had to move down to 26 basis point likely cut. Now that's moved up somewhere into the 30 basis points. So I think we're going to bounce around between 25 and 50, depending on how things go in the lead up to the elections. Um, but the U.S. government increased their deficit by $500 billion in September. So that's going to certainly boost things. And some would argue that's a positive for Harris if the economy is doing fine leading into the elections. So that's interesting. So the U.S. data is really mixed. So to your point, and with the employment and inflation numbers jumping around everywhere, I think this consensus no landing that people are talking about seems to still apply. And it's funny as I look at it, I think it's less likely that we're going to see a big market contraction into like a slow, drawn out recession. And probably if we do get a correction, it's going to be more like a 1987 style where we get a snap sell off, followed by buying back into bringing the market back to life here. So I don't anticipate that tomorrow, but I think it's much more likely of that case than the typical one where we have a recession, market corrects over two to 9 months, and then we come out of that. So I know that's a little bit of a long-winded answer to your question there, but certainly the data's mixed, and I think that's why the answer was long.
Yep. Drilling down to sectors, specifically the energy sector,
Mhm.
we have seen that traditional companies they're challenged by the choice between, clean energy or fossil fuel. What are your thoughts on this and also on BP selling the minority stake in the wind business?
Mhm. Yeah, so there was, probably 5, 6 years ago, there was so much attention put towards the big bad oil and gas companies. Yeah, things were moving along well in the world and the economy. Rates were low, energy prices were low. All these things were moving along smoothly. And then we had, I guess, a disruption to that in the world where obviously the natural gas got cut off to Europe with the Russia-Ukraine conflict. And then we started to see the attention start to pull away a little bit from that socially responsible investing, a little bit less money flowing into the space. And then we had the oil and gas companies start to question their commitment to it. And so it's an interesting evolution because if you look at some of the global, we'll say socially responsible indices, some of those top 10 holdings are energy companies right now, traditional energy companies. And so I think they're at a crossroads, and it appears, at least with BP, that they're just saying we're going to focus on our core business, and we're not going to tilt towards the socially responsible because we can't make money from it. It's not our core business, and that is a big shift. So it's a little bit of a challenge and surprise for me, but it's I think what they're doing, just focusing back on those businesses, similar to tobacco companies have done over the years, here and there, trying to make forays into different things. These energy companies have said we just can't focus on it anymore. I think also green energy is shifting too from just wind and solar to now a lot more attention to nuclear, where, nuclear 15 years ago was a bad word. It's certainly a lot more clean, a lot more energy efficient than it used to be, and people feel much more safe with it at this point.
Right. Anything else catch your eye?
So I think you did mention energy as well, which I didn't comment a little bit on last. I think it was earlier this week where Israel and Iran said they were going to settle and not. Israel said they're not going to bomb the Iranian oil and gas facilities. So you had a bit of a correction in oil on the back of that. So it's pushed down the stocks a little bit, making them potentially a little bit attractive at this point. But I'd say that was interesting. But I think there's a lot of political bantering that's going to happen between now and US election time. All these different leaders of the world trying to decide on, or at least play to both sides, depending on if Harris or Trump wins. I think you're going to see a lot of political bantering, and some of this Israeli-Iranian conflict, I think, would have been related to political stance that Yahoo's trying to make.
Right. Any changes in portfolios this week?
Yeah, so the one thing we've been talking about the last couple of weeks is just moving out of some of the sovereign debt, so some of the bonds in Canada and the US. So started to shift to that this week. So looking at reducing a little bit of the government exposure in both Canada and the US and tilting it towards corporates, high quality corporates. And so started to make that move and been using a couple of ETFs, one of them BMO corporate ETF for some of those shifts, and looking really at the yields and the safety, and really just trying to reduce kind of the interest rate risk in portfolios right now and move in from governments to corporates at this point.
Sounds good.
Mhm.
How about we go into the charts?
All right, sounds good. Mhm. So we are October 18th already. Let's see here. So we have multiple research sources that we're lucky enough to have access to. Excuse me. And this was a great piece from Evercore that came out and gave us an update on China's growth and forecast numbers. And so this is, everyone, what you want to believe the numbers or not, but the trajectory is, I think, interesting and important here. So as we went through, if we look at 2020, obviously we got a contraction, big acceleration into 21, and then a contraction again, big acceleration. And so I think this is why people have been concerned really about the trend more than anything, what's happening with the GDP trend here. So the view, at least from Evercore, is we probably see a little bit of a deceleration in GDP over the next 12 months. But what I think is more interesting is this is a great piece. These are China's key economic indicators. And, green obviously is better and red is worse. But if you're looking at consolidation when things are bottoming, ultimately the redder you get, the better it is from a perspective as you're reaching a consolidation point. And so we're starting to see manufacturing start to reaccelerate again. You're seeing the consumer come back here with the autos starting to pick up again, and general retail starting to reaccelerate. So, as I commented on, I think it was in today's piece where I say, they're trying to convert from manufacturing to consumption based, and you're seeing some rays of light there that we're turning the corner in a positive way. So this was total public debt from when Biden took office to where we are today. So just if you're keeping tabs on what that number is, the total public debt increased by $12 trillion over the last 4 years. And so we've had a massive increase, and to the point I made recently, $500 billion increase in September of this year. The piece which we haven't spoken about too much yet was just the inflation number in Canada that came out this week. And so we had the Canadian inflation number come in much lighter than expected. So 1.6%, which is lowest since February 2021. But also, I think it's important just to look at the numbers, actually deflationary number at this point. And so with the view coming into this week, we thought probably 25 basis point cut coming in Canada next week. After this inflation number, it's much more likely that that number is 50 basis points and maybe another 25 or 50 by the end of this year as well. So this inflation number was pretty surprising that came in on Monday. And so we'll continue to watch this, but that gives you a picture of what that looks like right here. I thought this was a great place just to look at the different major central banks. So you're looking at Australia, UK, Europe, the United States, and Canada, just to give you a gauge of where the different countries are, with the US being the green one. So they went up the farthest and likely have the farthest to be able to come back down too as well. So we're looking at this where Bank of Canada, as you can probably note here, we're the blue one, the 4.25%. We see that number continuing to fall, as well as the ECB. They're leading to the downside here, and they cut rates again this week as well. So we think there's lots of room for this to go. If we're starting to see a deflationary number start to come out in Canada, you know the central bank's going to be looking at that very seriously and want to cut aggressively to support that at this point. So just two more quick ones. One is what's up next week from a economic perspective, and then one more just a little bit on asset allocation. Then we can wrap it up here. But this is what's coming out next week. Wednesday's a big day, which is Bank of Canada interest rate decision, monetary policy report, and a press conference, of course. We got new housing price index month over month and year over year. Those will certainly be important to watch. And retail sales will also be an important number, as credit card balances in Canada are at an all-time high presently. So it'll be interesting to see how the consumer is doing when we get that number. Last piece that I thought was interesting, just to look at asset mix. And so, where most Canadians are heavily weighted to Canada, this is how the CPP is broken down for what their exposure is like to the Canadian market versus the rest of the world. I guess they've taken a little bit of heat from this, but Canada right here, you probably see would be this slide here, 14%, big chunk, 36% in the US, 26 in the Asia Pac. 18% in Europe and 6% Latin America. So just when we think about future and where investments and assets are likely to grow, I thought this was a great piece just to think about how one of the biggest institutions in the world is allocating their money. I think there's good opportunities outside of Canada, which we've spoken about multiple times, and we'll hope to evolve and talk about a little bit more as things progress over the next couple of quarters from here. So that's it for the slides today.
Great. Thanks, Ben. Anything else to share with us?
I think that was a lot that we see ahead, and a lot of opportunities still. But next week's a big week from a rate
Yeah.
perspective, and we think 50 basis points is quite likely.
Okay. Great. Thank you. For our clients, just a quick one. I'll be reaching out and setting up a secure document exchange platform. It's called Box, and this is where we'll be putting the quarterly reports, tax slips, and any other documentation. As usual, if you would like a meeting with Ben to review your portfolio, please reach out to me. For everyone else, please visit, subscribe, and follow us on our YouTube and LinkedIn pages at Hart Investment Group and our blog, excuse me, Daily Heartbeat for more financial news and data. Thank you for listening and have a great weekend, everyone.
Thanks, everybody.
Bye.
Take care. Bye.